Mr. Chair, members of the committee, Bob Samario, Interim Finance Director, and if it's okay, we'd like to take the investment policy first, and then we'll follow that with a pension item.
Thank you.
And so with that, I'll turn it over to Jill Tarr, our Treasury Manager.
Good afternoon, Chair Williams and committee members. My name is Jill Tarr, Treasury Manager, and I'm here today to present the annual statement of investment policy for fiscal year 2011. We'll ask that the committee review the policy today and recommend to council. The item does go to full council this afternoon as part of the consent calendar. Each year, staff updates the policy for any legislative or technical changes that may be needed. California Government Code 53600 governs all local agency investing activities for surplus funds. And over the last year, there were no legislative changes requiring an update to our policy, as well as no technical adjustments needed to it that would affect our daily investment activities. So with that, you have before you a status quo policy that continues to conform with state law and the highest standards and best practices for investment activities. With that, I'll just go through a couple of key points in the annual statement of investment policy for your review. First and foremost, the Statement of Investment Policy defines the permitted and suitable investments that we can buy and hold in our portfolio. As you can see, the permitted investment types for our portfolio are listed on the left-hand side, and know that state law prohibits local agencies from investing in stocks, commodities, futures, derivatives, mortgage-backed securities, anything risky or exotic we don't invest in. In some cases, the city's own investment policy is more restrictive than state law in terms of what we can buy to make sure that the items that we hold in our portfolio conform with our own portfolio objectives of safety, our own liquidity needs for cash flows throughout the year for operations, as well as yield. So I won't go through each of these, but the column on the left shows the permitted investment type, and the other three columns show the maximum maturity for each individual type of investment that we can buy, shows the maximum percent of any one of those investment classes that we can hold as a percent of the total portfolio, and shows the minimum rating if applicable. So as you can see, we can invest in U.S. Treasury notes and federal agencies such as Fannie Mae, Freddie Mac, Federal Farm Credit Bureau notes, all of which have a 5-year maximum maturity. We also can hold corporate medium-term notes. The medium-term designation means that it's a corporate note that matures no farther out than 5 years. We also can hold certificates of deposits from various banks, limited to 3% per issuer and a minimum rating of an A for the bank. And down at the bottom, you'll see the State of California Local Agency Investment Fund, or LAIF, which is our money market account where we hold our short-term funds that are needed for the operations. And that works well. We can pull down or send up money on a daily basis depending on the cash needs for that day. Secondly, the Statement of Investment Policy establishes investment objectives for our overall program. The number one priority is safety, designed to preserve principle of the city and RDA assets. And the safety objective serves to mitigate credit and interest rate risk for the overall portfolio. We meet this objective by buying only the safest types of investments, as you saw in the previous slide, by pre-qualifying all brokers, financial institutions, dealers that we do business with, as well as diversifying the portfolio between those investment classes to mitigate the impact that any one investment class can have on the overall portfolio. Once the the second objective is liquidity, and we make sure that we have maturities and cash on hand to ensure sufficient liquidity to meet our daily operational needs without having to sell security out of our portfolio earlier before it matures, subjecting it to market rate risk. Once the first two objectives have been met, we turn to yield and we look to attain a fair return on investment based on this low level of risk assumed in our portfolio. So we're not buying in risky investments and we're not getting the yield that you would if you were buying risky investments, but we buy the safest and attain the fairest yield compared to several benchmarks that we compare ourselves to, LAIF, the 2-year Treasury, and the three-month T-bill. So those are primarily the three things, the three tests that we go through before we buy anything into our portfolio. The investment policy also contains standards of care for all our activities. The first would be the prudent investor standard that is specified in the policy, which requires that staff act with skill, prudence, and diligence to ensure safety of the portfolio. It also specifies ethics and conflict of interest standards to prevent loss of any of the funds from fraud, employee errors, misrepresentation by third parties, or any changes in financial markets. The policy also specifies internal controls and specifies that staff would be prohibited from conducting personal business that would conflict with the program. The policy also delegates investment authority to staff within the organization. The city charter charges the council with responsibility for investing the funds. That authority is delegated annually to the city administrator and further delegated to the finance director, who provides oversight and management of the investment program. And then the daily investing activity is delegated to the treasury manager, myself. The policy specifies reporting requirements. Monthly, we submit, as required, an investment report to council, which includes a listing of all securities held in the portfolio, a list of all the investment transactions during the month, and the market value of the portfolio. Quarterly, we submit to council everything in the monthly report, including the list of securities held in the portfolio, the investment transactions for the entire quarter, and both the yield and market value of the portfolio. And we present an expanded narrative to talk about any economic or market changes affecting the return, talk about any foreseen changes, and our investment strategy. Lastly, the policy is flexible and allows for administrative changes to be made throughout the year without having to go back to council and through finance committee to make changes to our daily investments to take account any changes in the government code or any new GASB pronouncements, which would affect the way we do business. So there are no changes, and that's just a brief overview, but I'm happy to answer any questions you might have.
Questions from the committee?
None for me.
And then we are seeking a recommendation because this will go before council today.
Yes.
I recommend that we continue with the current policy and accept this report.
Second.
All those in favor, please say aye.
Aye.
Aye. Motion's unanimous. And then the pension report.
Thank you, Mr. Chair, members of the committee. The item is relating to really three plans, although they're covered under two separate sections of the Charter, Article 15 and Article 15A. This will be an item we're going to be taking to council next Tuesday, so we're looking for a recommendation from the committee to at least to forward to City Council the proposed funding plan for these retirement plans. And I'll go into the details, but what I want to point out is that these plans have been around for many, many years, and so some of the information related to them, how they started, some of the history is going to be difficult to get to, and I may not be able to answer all the questions, but I think enough to at least support the recommendation. But these plans were created a while ago. It was in the mid-'60s that the city went to the CalPERS program for all of its employees, public safety as well as miscellaneous employees. But prior to that, and I really don't know what it was providing for miscellaneous employees, but there were some defined benefit plans being provided for our public safety staff, for fire and police prior to the mid-'60s when we went to PERS. And that's really what we're going to be talking about, those plans, the status of those plans in terms of their funding status, and then some recommendations to at least partially fund some of the plans since they do have some unfunded liabilities. So with that. So just kind of by way of background, the very first retirement plan that we're talking about, and it's really named after the article that created it. The first is called the Article 15 of the 1927 City Charter. And then there was a modification to that section of the City Charter in 1937 that created Article 15A. And you can see that as part of those two charter amendments, if you will, or creations, there were three plans that were created, and I'll go through each one of them. The first is the oldest, the 1927 Charter Plan, Article 15, Service Retirement Plan. It's a lot like our PERS program. It's a defined benefit program, and it covers all police and fire personnel that were hired prior to 1937. So you can see it's a very old plan, and in fact, there's currently just one beneficiary left, and I'll show you how old that person is. But it's a surviving spouse. And the interesting thing about that plan is it was actually a fairly rich plan at the time, because it was anybody who was retired and getting a benefit, they were subject to the same increases as their corresponding positions were that were for existing positions in the city. So if somebody got a 5% raise in that position classification, they were then also eligible for the same kind of an increase. So you'll see how much they're getting paid today, and it's a fair amount. The other plan that was created in 1937, the Article 15A, is also a service retirement plan, so it's just like the Article 15 plan. It's a defined benefit plan, but it covered all police and fire personnel hired between 1937 and 1965, and in 65 is when we went to PERS. And for this particular plan, what's interesting about it is, or unique about it, is that a separate fire and police trust fund was created. So we actually have a separate trust, and that trust is being managed by Santa Barbara Bank and Trust, and we have an investment manager who handles all their investments, and they do take care of the investment of those funds, separate from what we do here at the city with our own city funds. And there are currently 7 beneficiaries, and this plan also is unique because it's governed by a 5-member commission that was created pursuant to city charter. There are currently 3 we have actually on the commission because we couldn't find 2 others, but we have a 3-member commission, but the charter provides for 5. And so that's an important distinction, because we'll talk about that in a moment. And then the third one is the same as Article 15A, except that it covered those who either died or were permanently disabled during the course of their employment with the city. Again, it was part of the 1937 charter. And currently there are 9 beneficiaries there, again, primarily surviving spouses. So just some history of the plans, how they were originally funded. They were very similar to our CalPERS plan. They were funded in part by employee contributions. It was a percentage of their payroll. And then the city made contributions as needed to make up the difference, just like we have with PERS. And those contributions that the city made were based on periodic actuarial evaluations. So every couple of years they would determine what are the needs of the plan, and the city would make up that difference. And it was also funded, just like with PERS, on the earnings on the investments. So the assets that were in the plan would earn money, and that would offset any need for employee or mostly the city contributions. But once the final employee retired, and I'm not even sure when that was, but I'm sure it was within the last 40 years, the plans were essentially funded solely from interest earnings. There were no more employee contributions being put into the plan, and there were no more city contributions. It was all being funded from earnings on the plan assets. And as you can see how the plans became underfunded, that at one time, I presume that all of these plans were fully funded. I'm pretty sure that they were, because I look back, and you'll see some of the numbers just 12 years ago, that they were pretty close to even being funded back then. But theoretically, they were all fully funded based on an actual evaluation that said you needed X money in the bank, and based on the assumed rate of return on their investments, they would have plenty of money to cover all the defined benefits for the people for the rest of their life. Unfortunately, or fortunately for the beneficiaries, a couple things have happened. One is that the investment returns presumably were lower than the actuarially assumed rate of return. I don't know that for sure, but I'm assuming that because, as you'll see, we have a substantial unfunded liability that had to have been created either because the assumed rate of return wasn't achieved, or what I think was probably the bigger factor is that the number of years lived exceeded the mortality assumptions. And I wanted to show you first a table that compares, and this is as far back as I can go in the data that I have, the funding status of all of these plans going back to 1998 and what they were as of June 30, 2009. First, you'll see that the column is Article 15 service retirement, and then the death and disability retirement. I've combined those two together to show the subtotal because those are the ones that aren't part of the separate trust. Those are essentially being paid out of the general fund. And the last one, sort of the fourth column to the right, is that one that was covered by a trust. But you can see that the actuarially accrued liability, that indicates how much money should we have essentially in the bank in order to fully fund all the defined benefits for the remaining life of the beneficiaries, when you add all the interest earnings that are assumed. And you can see that for the Article 15 service retirement, the actual liability was $1,026,000. We had a combined with the first two, so $1,026,000 and $1,009,000. We had a total accrued liability of $2 million and plan assets of about $1.4 million. So we were already underfunded in 1998 in those two plans combined, and they are treated as one combined plan. Whereas in the Article 15A service retirement plan, again handled by in a separate trust, you can see that we were almost fully funded. We were pretty close. And then below those numbers, you can see what the number of beneficiaries were at that time: 5, 16, for a total of 21, and then 14 in the separate trust fund for a total of 45. And now in 2009, June 30, 2009, you can see the story has changed pretty dramatically. The accrued liability has gone down because people have, basically have passed away. So our accrued liability for the first two were $657,000, but the plan assets were actually a negative $448,000. And what that means is we've been paying basically in borrowing from the general fund to cover the monthly benefits that are due to these beneficiaries. And so it's created this negative cash. So our unfunded liability is about $1.1 million. In the Article 15A service retirement plan, their liability is $815,000. There are some plan assets in this trust, $321,000 at least as of June 30, 2009. They were $321,000. So our unfunded liability is a difference of $493,000. But you can see the far right in total, our unfunded liability as of last year, June 30, 2009, was almost $1.6 million. And again, you can see the number of beneficiaries has gone down substantially from 45 to 17.
I think the beneficiaries in Maine is 35.
Is it 35? 21? 35, I'm sorry, it is 35. 21 plus 14. So let's show this table here. This one here. This is a page out of the actuarial valuation as of June 30, 2009. And I think it's interesting because, what's really caused us to get into a position where we have an unfunded liability like we do is that, again, people have lived longer than expected. And it's one of those statistical sort of things when you ask the question, who is more likely to reach the age 90, a 60-year-old or an 80-year-old? The answer is an 80-year-old because they've already gotten there. They're almost there. And so as the people have gotten older and, in a sense, have become statistical anomalies in how long they're living, it just means that we have they're expected to live that much longer, and our liability grows beyond what we were assuming 30 years ago. So back 30 years ago, 40 years ago, they might have assumed these people were going to live to be age 80. But once they reach age 70, 73, 75, all of a sudden, no, their expected life expectancy is more like 90. And you can see that the one beneficiary that we have under the Article 15 plan is now 92.9 years old, and they're receiving $3,790 per month. So a very, generous benefit, if you will. We have under the Article 15A service retirement, we have 7 individuals. You can see that their average age is 82.7, and in total we're paying about $98.76 per month. And then the last one, service, death, and disability plan, we have 9 members. Their average age is 80.9. What's interesting is the grand total is 82.3 on average, their age, but down below you'll see that the life expectancy for the group is an additional, on average, 10.9 years. They wouldn't have come to that conclusion 30 years ago. And again, that's really what's over time has caused us to be in this position where this unfunded liability has grown. It's gone from a fully funded status to an unfunded status. Or underfunded status, I should say. So the question is, if we can go to the outline, thank you. Go down below. You can see why fund now. We've known about this for a number of years. I would say we've known about it for 5 years for sure. We've seen the trend sort of continue to be negative. I think there was some thought that it's possible that we would see some actuarial gains, if you will, that people wouldn't live as long as they did because if a few people pass away, I know this is kind of hard to talk about, but if a few people pass away beyond what's sort of been actuarially assumed, the liability drops dramatically. And I think we've been monitoring it for several years, a number of years really. But once it got to be where the numbers started to grow, the unfunded liability started to grow, we recognized we probably need to do something. And I think there were commitments made to the Fire and Police Pension Commission, at least for that one separate plan, that we would try to at least address that unfunded liability. And that was probably a couple of years ago, right before we hit our economic downturn. And so we kind of put things on hold. But so anyway, we have made commitments to the Fire and Police Pension Commission that we would address this unfunded status. One of the other reasons to fund now, perhaps, is that in the separate trust, they are able to invest in things that the city cannot, and that's why they assume anywhere from a 4 to 7% rate of return. Similarly to like PERS, they invest in things we cannot, and that's why they have, over a long period of time, more ability to earn more than we would. We're earning now 2 or 3%, where they can earn 7% perhaps. And so by putting money into this fund, we can allow them to use those investment earnings to help defray some of that unfunded liability. And the fact is that the unfunded liability will continue to grow. We don't do anything. It's just we're just going to let this problem grow over time, and we're going to be dealing with a $2.5 million problem 3 or 5 years from now. And it's probably better to do something now, at least to partially fund based on some funding we have. So the question is, where do we have funds? And we've identified some sources of funds, not to fully address the unfunded liability, but at least part of it. And so a number of months ago, as we were looking at our workers' comp fund, our self-insurance fund, and looking at how we might be able to reduce premiums charged to the general fund and the like, I looked at a report that showed what our required reserves are. And as you know, every couple of years we do an evaluation or evaluation as well there based on outstanding claims, workers' comp claims, or liability claims. And those reports indicate to us or suggest to us how much money we should have in reserves to fully fund those obligations, those outstanding claims. When I looked into that report, I noticed that there was a provision in there for what's called 4850 time. And for those of you who don't know what that is, for fire and police personnel who are injured on the job, they are entitled to benefits that other employees are not. And what they're entitled to is, under Code Section 4850 of the state law, 100% of their pay for up to a year. So if they're injured for up to a year, they get 100% of their pay, whereas other employees they get a small fraction of it. And that's called 4850 time. And there was provision in there in this report that we've been funding for 4850 time, but it occurred to me that we really weren't paying those benefits out of the self-insurance fund. They're being paid out of the respective department, police and fire. They're budgeted positions, and if they're not there because they're injured, we still have that budget there, and we still pay for them out of that budget. So there's no incremental impact to us where we need to set aside additional money in our self-insurance fund for that purpose. So in effect, we've been accumulating money that we really didn't need in that fund. And so we identified that and said, well, here's an opportunity. We've been wanting to address this unfunded liability in our retirement plans under these 2 sections of the charter. Here's some extra money we identified. It relates to police and fire, because that's why it was created. And so we're suggesting that why don't we use those funds to at least partially offset some of these unfunded liabilities in the 2 plans. So our recommendations are, and you can turn to the other chart, we've identified about $717,000, almost $718,000 that was established for this 4850 time. And we're saying let's apply $493,000 to the Article 15A Service Retirement Plan first. So we'll fully fund that unfunded liability. That will provide them monies that they can invest more aggressively than we can. It will satisfy fully that obligation. Now, it doesn't mean that 5 years from now we might not have to kind of revisit this, because we might see that people are living to be 100, and so we'd have to address that. But it's possible that the reverse would happen. But we think for now we would be able to cure this problem for a number of years, and we'll continue to monitor that. And then the remaining portion of the $718,000, we'd say let's put into the 2 other plans combined. We're still going to be left with an $881,000 liability, if you will, but at least we're making some progress toward dealing with that. It's really a negative fund balance we have essentially in that fund within our city funds, and it's we're going to have to deal with that at some point. And so I'm suggesting or recommending that take at least part of the money and reduce that liability. It's going to probably grow between now and 5 years by another $300,000, but at least we're making some headway toward reducing that liability that we're going to have to solve at some point. So that's the recommendation today. And so with that, I'd be happy to answer any questions.
Questions from the committee members? Yes. Councilmember Self.
Thank you, Chair Williams. Does this negatively affect the self-insurance that the police department now has?
Mr. Chair, Councilmember Self, no, it doesn't. So this is just really money that we've accumulated in the self-insurance fund really unnecessarily. And so it's not going to have any impact on the amount of reserves we have for all our other outstanding claims. And it doesn't affect, and I think your question was, does it affect sort of existing police officers? No, it doesn't have any impact on really anything other than allowing us to address some of these liabilities.
Okay, so this self-insurance fund, this has been from the general fund to fund the self-insurance fund. So that really, correct me if I'm not seeing this right, it means the police department has been overcharged this amount. It's been shown that their budget liability is greater than it actually has been.
Yeah, I'm not sure if it's the police and fire who have been overcharged. I think collectively for all of our workers' comp programs, we've overcollected in premiums, overaccumulated funds from all city departments, if you will. So it wasn't like we were tracking and accumulating from the police and fire departments an amount just for 4850 time. It was sort of part of the overall pie. So everybody sort of shared in that overcharge and therefore the overcollection and accumulation of reserves in that fund. Does that make sense?
It does make sense. I guess my having just gone through the budget process and seeing how much we are needing for general funds for the police and fire, but you're saying this 717 is been collected from all departments, even the enterprise funds.
I'm not sure it's in enterprise funds, but it basically from all general fund departments.
Okay, thank you.
And I just want to comment on, because I use the term overcharge. I think it's important to remember that 3, 4, 5 years ago, we had an unfunded liability in the self-insurance fund of $4 or $5 million. And then what happened is that we boosted up the premiums to the departments, but more importantly, we implemented a pretty aggressive safety program, and then also the state changed the workers' comp law. And so over the course of 3 or 4 years, we went the other way. And what was an unfunded liability became, we were overfunded. But that's the nature of when you collect, you base it on historical patterns. And as the trend of the accidents went down, we adjusted the rates. And in fact, we transferred, I think, probably $3 or $4 million out of that fund into the general fund over the last couple of years to help with our financial difficulties. In this situation, this is almost an actuarial anomaly, because we basically, when we determined what the liability was, the actuary was including this 4850 time. We didn't worry about it when we were underfunded because we didn't have enough money in that fund. But now we've examined it more carefully, and we said this is it's for police and fire, so it's a good place to move that money into this retirement fund. But I want to be real clear. We weren't overcharging the departments in order to generate a surplus here. Just as every 2 years we do this actuary, and really what happened is the actuary said, now that your safety record has improved so much, you had the same amount of money there all the time, but your liability has gone down because you're not having the accidents and the injuries that you had in prior years.
Thank you for clarifying that, and I guess that was kind of an accusatory word, but out of that I got a better explanation, more complete, and I thank you for that.
Mr. Francisco.
Mr. Samario, it seems logical, if we've got this unfunded liability in the pension system, in the old pension system, and we have this excess that we didn't know about before in the other, it seems logical to move the money there, but just out of curiosity, since this would be backfilled from general fund, right? So I assume that if we wanted to, that 719,000 could also go into the general fund. There's nothing restricting that, correct?
That's correct.
Okay, thank you.
I have one other question. I support this recommendation, and I think it's a good recommendation. But in terms of budgeting for future years, perhaps we should be Because what this creates is a strange situation where it makes our shortfall look bigger than it really is, because we're taking away some more funds out of the general fund into the self-insurance fund, and then later on usually using it to backfill a deficit, right? But as far as budgeting for future years, wouldn't it make more sense to try to budget this a little bit less or a little bit more conservatively, or at least a little bit less going to the self-insurance fund, from the onset in the budget, and making sure that, our budget reflects reality, because at this point it makes it look like it's worse than it is.
I think the other option that we looked at, and if we hadn't had the 4850 money in the self-insurance fund, would basically be to increase the amount we charge the fire and police departments out of their line items for retirement, to put the money into this fund, and what we typically call pay as you go. And as you saw it, I think the amount we have going out the door is about $2,000 or $20,000 a month. So we'd have to increase cost by $240,000 a year to those two departments, and that's another way to address this. And probably when we get 5 years from now, that'll probably be the way we get rid of the rest of this liability. But you got to pay it one way or the other, and one would be to add to the operating costs of the departments. We just felt, since that money was there and we're fully funded in the workers' comp fund, that this was the appropriate place to do it.
Okay. Is there a motion?
I'll move that we recommend to the full council that we move these funds as recommended.
Is there a
Second.
second? All those in favor, please say aye.
Aye.
Aye. The motion's unanimous.
Thank you.
And we'll adjourn.